And welcome to the Movie Market Podcast. I'm J.R. Gondeck, and as always, joined by David Sokolovsky. David, I think we could have a 3-hour recording this month, recording and recapping everything for the month of April. So let's dig in and kind of hit the high points as best we can with all the noise and information the past month.
Sure. I think a lot of those high points may really be low points for the month of April. But if you look at just the overall activity for the month of April, we just saw a significant increase in volatility and a lot of market uncertainty that came with the tariff announcements, the subsequent pause, and then the ongoing negotiations between the different countries for a potential trade deal. But if you look at major market indices, the S&P 500, after dropping significantly in the first few days after tariff announcements, basically recouped all of the losses and finished the month down less than 1%. International stocks were one area of positive growth, which had the emerging markets being slightly positive and the developed markets up about 3.5%. And we'll talk about the reasons why that is, but markets may be pricing in some trade deals or further tariff delays. We'll touch on that a little bit more in detail. But if you look at other areas of the market, value companies really underperformed in the month of April. And again, I think that was just kind of a rebalancing and catching up to where growth has been. The dollar weakness helped drive some of the strong earnings news that we've seen in recent days and weeks. And then dividend stocks and bonds, which has been one area of safety, with dividend stocks being the lowest performers for the month of April, but generally strong throughout the year. And then bonds were slightly positive. And that really highlights the importance of having, a diversified portfolio and then also just solving for income first. So making sure you have the income that you need out of the portfolio, and then you can ride out the volatility without, significant disruptions.
David, let's dig into maybe the why, for the month of April, because again, as many of us were looking at the first week or so of April, the expectation was far greater losses, a bigger economic drawdown, and the volatility picked up. And then you've had over the last week or so 10 straight positive days within the market. The question a lot of people's mind is why. And part of the explanation might be, as you alluded to, David, some of the tariff discussions have been delayed behind the scenes, or there's been, between the U.S. and China, China's waived 40 billion worth of goods. The US has waived over 100 billion worth of goods on tariffs for now, so the impact hasn't been nearly as big or worrisome to the markets at this point. So that could be. And the other big trend is the dollar. So as we've talked about the dollar, the expectation with tariffs would be the dollar would strengthen fairly dramatically. And you saw that, as the Trump presidency was priced in late last year, from October into the end of the year. But then to start the year and all the way through, the dollar has been down 8 to 10% overall. And again, you'd think that'd be a bigger challenge to the markets. But if you focus on a potential positive with the weakness in the dollar, it is multinational companies, right? And you saw this within tech earnings over the last week or so. They were great across the board. And when you look at the impact, again, all of these companies, almost half or more of their revenues are from foreign countries. So if you think about the impact of a strong euro, if I do the same amount of revenue in European Union, I bring those strong European profits back to the weak dollar, it's helped results. And again, across the board, you had very good tech earnings. On the other hand, by mid-April, a lot of these tech companies were down 30% or more from their high. So there's relative value, and the concern around valuation, which we've talked about over the last 2 years, all of a sudden become a little more reasonable as well. And then one big thing with the trade that's ignored is the amount of service revenue. So if you look at the huge surplus that the U.S. has from a trade deficit on services alone, it's a huge surplus. So a lot of the discussion around tariffs have been focused solely on goods. But again, that service revenue component to the U.S. economy and big multinationals and especially tech companies is very, very large and sustainable. And again, you saw that with the steadiness in first quarter results and outlooks being, for the most part, better than expected. So again, that seemed to be propelling a lot of buying within. Well, number one, valuation, but that weakness in dollar definitely helped results to mitigate some of the concern in the short run overall. And again, that's partly why you saw huge rebound in the growth area of the market. And again, looking ahead, still to me, we're kind of at that 50-50 point. You can make a good case that the markets could go up from here. You can make a compelling case that there's still a lot of challenge. And I think in a lot of ways, you continue to be in a wait and see approach. But overall, that seems to be one of the major reasons that you saw a big bounce back toward the end of the month into May.
Yeah, and Jaron, a big driver of the volatility is the market's always looking ahead, right? And is a leading indicator. So it's trying to price in the different types of activity, the different types of tariffs that we may see, and ultimately what trade deals come to pass. And so as you see some of that volatility subsiding, we reached, a very high point in the volatility index in April, reaching about 65, which is the VIX. And that just shows, significant market concern and obviously followed by the significant drops in the market. But then we've had a recovery where the VIX is still elevated. It's still showing there's more fear in the market than optimism, but it's getting down to a reasonable level. And as right now it's around 22, as it reaches kind of the teens, the high teens or the mid teens, that shows that a lot of the market volatility has subsided. A lot of the options trading activity has slowed, and there's potentially less risk at that point.
And that's critically important, David, because in the month of April, when everything's whipsawing like this, it's hard if you're running a company to make a long-term decision. If you're an individual consumer, to make a big purchase like a house or other things, you're on a wait and see approach. As the market calms and steadies in, a lot of those decisions can be made in the weeks ahead, and that's important for future economic growth as well. Let's talk about the labor market inflation now, David.
Yeah, so if you look at the labor market, what we've seen is, and I guess just the overall economy, I guess one thing to hit on that was announced last week was the GDP number, and it just showed that GDP contracted significantly less than expected. So less than the Atlanta Fed model, which suggested a 2.7% decrease in the quarter. The gold adjusted number, which is a recent addition that they've made, was projecting a decrease of 1.5%. But really, the economy slowed at a very small pace of 0.3%. So again, the slowdown was not as bad as feared. I think a lot of that economic activity may have been pulled forward on concerns of tariffs and prices rising. Um, but if you look at the labor market, not in a very bad spot, to be honest. You have 177,000 jobs that were added. Um, Last month, and the prior month was revised slightly lower, but you're just not seeing the challenges in the labor market, and that's a very important one for us to watch. As we know in the U.S., the consumer makes up about two-thirds of the overall economy. About a third of that is shelter, um, and if you just look at overall economic activity, services remain important. That's driven by a healthy consumer. The one area that's a bit troubling is you have continuing claims that have moved slightly higher. And so again, those are people who have lost their job and continue to claim unemployment benefits who are looking to get back into the workforce. But you've seen that number tick up. And if it stays elevated, that could be a problem as people search for work for longer, and ultimately reduces spending. And then also, as you look at kind of the challenger job cuts and also the surveys ahead, as JR mentioned, when there's ever economic uncertainty, companies will pause and reassess. They may pause and slow down on capital expenditures, which can slow down the overall economy. But they also may be looking to strengthen their balance sheets and their income statements and essentially just hold off on hires that they may be looking to make. So if that's the situation, again, it's an important one to watch because that impacts the overall economy. On the inflation front, as we continue to track that very closely, you really haven't seen a significant jump in inflation. And looking at where inflation has been, we'll get another reading next week. But inflation has been trending lower, and again, energy prices have moved lower. There's been some easing on shelters, and especially in some of the hotter markets like California, Florida, and others. And you're seeing some of the markets where historically they've been a little bit weaker, like the Midwest. Prices are really kind of hanging in there. So depending on where interest rates go and as things start to improve and as more clarity emerges, you may have a pickup in housing activity, which we talk about quite a bit because housing is such an important part of the overall economy. Whenever you buy a house or you ultimately move, you're hiring movers, you're hiring painters typically, you're doing a little bit of work to the house, changing some things around, and that just has a positive economic effect because each of those transactions involve a number of different vendors, and obviously that spreads throughout the overall economy. But as we look ahead, if if the estimates are correct for next week, we're likely to see inflation pretty much unchanged or maybe ticking slightly lower on an annual basis. And that actually gives the Federal Reserve a little bit more flexibility to potentially lower rates um, to to accommodate, lower inflation.
Well, and you look at inflation, David, because again, the fears from the tariff impact are likely not going to be felt too much in the month of April, right? So it'll be interesting to see, like you said, the expectation is a 3% increase, but gasoline prices, for example, were down 10% in the month of April. So again, you're to see some relief there. Shelter seems to be leveling off, and there don't seem to be a lot of pockets of huge increases yet because of the tariff pause and other things. So that the concern around increasing prices could be pushed out a few months, if ever, right? Depending on how these trade deals and things come to pass. So it really puts the Federal Reserve in a continued tough position that you might see improved data, around CPI and inflation near term, but you're still not going to trust it until there's deals and some steadiness overall. So despite the fact that the Fed could potentially lower interest rates with the labor market being in okay, at this point and inflation coming down to normal levels, they're going to remain hesitant just because of the continued unknown. And again, when you look at recapping earnings season, to me, it was a big surprise. I expected more companies to pause their outlooks. You're right. We saw a number of those, but the earning expectations, almost three-quarters of companies beat their earnings expectation, and almost two-thirds raised their beat revenue as well. And many of these raised outlooks. So it's again a good sign for the valuation that the correction in place has offered some opportunity within the markets. Having said that, it's still time to look for opportunity and remain a little bit cautious. Again, as we look ahead, there's clearly opportunity. You've seen mergers and acquisitions start to pick up over the last week or so, which again is another encouraging sign overall. But again, I think our plan continues to remain look for some of these opportunities. We've done some selective buying toward the end of the month, again, around attractive valuations and growth models overall. Having said that, maintain a little bit of cash. And one other, I think, thing to mention here as we close up is just an end of an era with Warren Buffett kind of stepping down as CEO, and again, between Warren and Gene Lerner, kind of our mentor and founder, I mean, there's two legends, from the standpoint of valuing companies and understanding the markets and providing guidance overall. And Warren Buffett was just a key icon from the investment world. And again, at 95, almost 95 years old, it's interesting to see the timing of that, but you can't say enough about Warren Buffett, what he's done for the markets over the years and where things are going. So, sad to see a legend go, but again, he is in all of us from investor standpoint and like I said, carry through a lot of those principles into the future. So with that, thank you for tuning in, and we'll touch base next month.
Thank you.